Hello, everyone. Mic check. Making sure my audio is working here. Welcome and thanks for joining today. Today, we are going to be covering estate planning, specifically for federal employees. So we're going to be tying in your benefits today. My name is Neil Kane. Thanks for joining. This is RetFed's session on estate planning. Real quick housekeeping items. You'll be noticing on your Zoom functions that you have the ability to do Q&A. That's where you can put your questions. A recording of this will be done and be sent out to you. And the slide deck will also be available, and that will be sent out to you in the same email. So you'll be receiving those. Um, Closed captioning can be turned on through the Zoom functions as well. And be sure to hang on to the end because we will have a QR code that we're sharing for a one-on-one meeting if you want a little bit more personal direction and have some personal questions and things that you want to get addressed. So when we talk about RedFed, we really talk about, blending in training with federal benefits, but with how that fits and relates to the outside world, retirement planning strategies. And specifically today, that's going to be through estate planning. My background as a certified financial planner, I double up as a chartered federal employee benefits consultant. So that's a little bit about myself. I excluded the slide that talked about myself simply because I wanted to make sure we had enough time to get through the content and moved you through. I know that this is mostly going to be, a blend between civil and foreign service. So I wanted to address the fact that we do have slides that correspond to both. We can field questions if you have specific questions on those, but I'm going to start off with the areas of estate planning that are directly tied to your pension and benefits, simply because these are very important to know inside and out. All right. So the first part that we talk about when we talk about a benefit that your family will receive if something happens to you is clearly going to be the survivor benefit. Now, this is kind of a boring way to start the presentation simply because this is not an election that you make until the end of your career. You're not deciding on this benefit now. You're not going to, ever see any paperwork. But when you do make that transition to retire and you get that final packet, you're going to be making a decision on your federal benefits, and you're going to be choosing one of the three options, which is either a 0, 25, or 50% survivor benefit for your spouse or partner, right? So now, if you make some of these choices, right, specifically the one with survivor benefit, 25 or 50%, that comes with a reduction to your own pension, right? So that is something to be aware of. Now, not getting a survivor benefit would probably be a mistake. I'll tell you why here in a second. If you look at this chart, right, if you take the 0 survivor benefit, your pension would not be reduced. So in the example of 50,000, the survivor benefit is 0. So this person in this example would receive their full survivor benefit. Okay. Now, sorry, their full pension, 0 survivor benefit. However, keep in mind, if you do not make a survivor benefit election, you do not cover your spouse at the end of your careers, the eligibility for health benefits for that surviving spouse would be in jeopardy if you passed away. One other thing to note when it comes to surviving benefits is, let's say you elect the 50% survivor to give your spouse the coverage of giving, up to 50% of your pension. Let's say the example is pension's 50. So now they're going to get a $25,000 pension if you pass away. But that means your pension takes a 10% reduction down to that $45,000 figure. I'm going to draw on the screen. Maybe that'll be easier for you to kind of know these numbers, right? So if we're taking the 50% survivor, that means we're only getting a $45,000 pension instead of the 50, right? And that will give us the eligibility of health benefits for our spouse to continue. Same with this 25% survivor. Now, you may have also heard that you can change survivor benefits at retirement. Within the first 30 days, you can make an election that is not going to readjust any calculations. So that's kind of like a freebie window. Outside of that, you have 18 months to then make a change to your survivor benefit election. However, keep in mind you'll have to make a deposit of any other money that you received that you shouldn't have. Let's say you took a survivor benefit that was um, low, all right, or 0% survivor, and you want to switch it out to 50, you're gonna have to pay that money back. Okay. So I got a question. Please don't assume people are married. Please address the same subject matter for single and child-free people. Sure, but this is a survivor benefit slide. So it deals with either you being married or you also are going to be in a scenario where you have a partner. There's some rules around that when you make those elections. But I just wanted to make that clear that you guys have these benefits and they do affect those surviving folks, your family. Now, the children's survivor benefits, let's say your partner, your spouse aren't around and receives your pension benefits. Well, here's this slide that talks about that. Your children have the ability to receive survivor benefits. You've got the benefits of $600 a month per child, or $1,800 a month divided by the number of children. But there's eligibility requirements, right? So the kids have to be fairly young to receive this benefit. And they've got the eligibility for being reduced by Social Security if they're receiving Social Security. So a couple of these, slides are, let's call it more on the boring side, but it's very important for you to know as a federal employee that they exist before we get out to the general estate planning stuff. One benefit that folks don't really know is a death in service benefit for a spouse. This is something that is automatically applied when you first start working. It's not an election that you make at the end of your career, like the benefits I just showed you. And it is alive right now for every federal employee if you have a spouse. Now, as you can see, there's kind of a cutoff here, 10 years. If you're under 10 years, your spouse would get a lump sum only of about $32,000 index for inflation plus 50% of the high three average salary that you had. So let's say high three salary was 100K, you would get 50% of that. So that's going to knock you down to, let's call it 50,000, right? 50,000, add the 32 back. And so your surviving spouse is going to get $82,000 of a lump sum payout. Now that's going to all be taxable. So the benefits that you get from OPM under the surviving spouse or the death in service are all taxable benefits. There is a benefit that's not taxable. I'm going to talk about that here in a second. 10 years or more gives you the same index lump sum plus a surviving annuity to your spouse if you pass away while in your working career. So that's already running in the background. Why do I explain this slide? Because generally, I see a lot of folks carrying a great deal of life insurance for their spouses, and they don't necessarily know that that benefit exists, right? So life insurance through the federal government is FEGLI, but just in general, life insurance, including FEGLI, is tax-free. So that benefit is tax-free. The benefits I just spoke about in terms of surviving pension, in terms of that surviving lump sum benefit, that is not going to be tax-free. That's taxable as income. So that's what really differentiates life insurance. That's why it's popular. It can be excluded from the gross estate if you're worried about estate taxes. I'm going to talk about estate taxes here in a second. But that means someone else has to kind of own it. So that can get a little tricky. You have to set up a trust for those scenarios, but usually that's not needed. And what is life insurance for? Well, really simply, a lot of times it's an immediate payout. It does not go through probate. So therefore, there's really no kind of vetting process of life insurance, you report someone passed away, you have a death certificate, that insurance company is going to kind of go through the motions of getting that payout to you as fast as possible. So generally speaking, that's the first kind of monies that come in for paying off debts, burial expenses, other kind of expenses of the estate through life insurance. Okay, so FEGLI. I want to touch on FEGLI because it's a widely used popular benefit by federal employees. It is your life insurance benefit. It is definitely part of estate planning. And I want to touch on the differences between the different types of FEGLI that you have. First, I'm going to touch on basic. This is a basic slide only, right? So the basic slide is going to essentially pay you 1 times your annual rate of pay. Sure, if you're younger, you get a little bit more. But as you kind of drift into your 40s there, it's 1 times your pay, right? Number two, the government pays 1/3 of your FEGLI premiums, okay? And then number three, age is not a factor of cost. Those are very different from the other additional options that you're going to see when it comes to FEGLI. You have A, B, and C, which I'll talk about here next. But those two factors, the government pays 1/3 and age is not a factor of cost, is really solely exclusive to FEGLI Basic, which is why it makes Basic the much better insurance than the other three options. I got a question. That question was, is a surviving spouse benefit available whether you purchase life insurance or not? If you do purchase life insurance, does the benefit go away or is it added to the insurance payout? Sure, great question. They're completely separate benefits. That's why I wanted to address that. Most people don't know about that surviving spouse benefit. So they end up taking extra multiples of this FEGLI because they didn't know that there was going to be that lump sum benefit plus the 50% of the accrued pension if that employee's been there for 10 years or more. So thanks for asking that question, and that's the clarity on that. So age is not a factor of cost. Government pays 1/3. So because of the fact of age is not a factor of cost, that's a big deal. The basic benefit is really easy to take into retirement. Not so much the extra multiples that come through option B or C, but the FEGLI Basic is very simple to take into retirement. Now, a couple rules about it is you've got to be insured for 5 years immediately preceding retirement. You have to also be eligible to retire with an immediate pension, and then elect, obviously, to continue that coverage and not convert it to an individual policy. Here's your options at retirement if you want to reduce it, but you can't increase it. I will skip to this next slide because this is kind of a really cool visual slide that allows you to see, let's say a federal employee has a $97,500 salary. You do the rounding up. We're going to give this an example of $100,000 of life insurance. So the first option for this federal employee is to be not to reduce it. They don't have to reduce their life insurance coverage. Now, age is not a factor of cost. So that means on this basic, the average federal employee is probably paying somewhere between $50 to $60 a month. How do I know that? Because age is not a factor of cost. What would make the difference of what someone would pay? Well, how much life insurance you're covering, how large your salary is. So that's kind of why I'm giving that range. Sure, could it be a little bit over that $60 number? Sure, it can with some of the bigger salaries, but generally not. 50 to 60 bucks. So if you're going to elect to take your full FEGLI Basic insurance into retirement and do that no reduction option, expect to pay around $300 a month. Why does that get more expensive? Age is not a factor of cost. Because at retirement, they don't health examination. They don't give you a health examination like traditional life insurance does. Life insurance is going to give you a health examination upon getting approved for that insurance. FEGLI doesn't do that while you're working, nor do they give you any sort of checkup while you're leaving, right? Through retirement. So they need to make that more expensive to make that decision more difficult for you to take that full amount with you. Because obviously, starting in your 60s, your health is going to deteriorate and they're going to be, more on the hook to have to pay out a larger sum if you take that as a no reduction. So expect to pay more then, but not in your working career. Now, what will also happen if you have some of these other choices? We have the 50%, but I'm going to talk about the 75%. You've got the option to do a 75% reduction, and that cost is free. So essentially, the way that works is if you retire, let's give you the example, this person's retiring at 62, they choose a 75% reduction. They'll keep that 100K intact for the first 3 years of retirement, because at 65 years old, that is when that insurance benefit will begin reducing down to only 25% of what they were covered, right? That $100,000 goes down to 25,000. They'll pay the $50 to $60 a month up until 65, and then at 65 it'll become free. And that same thing happens with the other benefits. You pay the $50 to $60 a month, and at 65, then you would receive the new cost. Okay, if you did the no reduction as well. That is how this works. Or if you get the 50% option right in the middle, I don't see that used as much. Generally, it's no reduction or 75%. So the main question that comes from this is, okay, what should I use? Well, generally speaking, we say if you're not in great shape, you're not in good health, you've got beneficiaries you want to cover in retirement, that's where the no reduction can be used. On the latter side, you're in great shape, took really good care of yourself, you foresee yourself living into your 90s, 75% reduction option seems pretty good right there, especially if you're not too concerned about leaving money for your beneficiaries. You do the 75, get the $25,000 of a free policy. Okay. And it's for this reason we normally recommend a federal employee carry basic. Someone may raise their hand and be like, well, I'm 25 years old or I'm 30 years old. I don't have any wife. I don't have any kids. Maybe it's that person that put their hand up earlier. Why should I carry FEGLI? Well, really, we recommend carrying that FEGLI option because it's an inexpensive way to get life insurance, right? You can convert that into a free life insurance policy. It's tax deductible, right, while you're paying it. And again, all those premiums that you pay end up kind of coming back as that free policy. So you have something in place for that end of life, for the burial costs and things like that. So we recommend it because also it's harder to attain. FEGLI Basic open season doesn't come around often. I don't know if you've noticed. There was one stint where like the open season for FEGLI hadn't come around for like almost 15 years. That's because they make it harder for you to jump in once you choose not to get it. Now, there are the qualifying life events, right, which is marriage, having a child, a couple others where you can opt in outside of open season. But other than that, there's not a lot of opportunity. So when an open season comes around, if you don't have basic, we'd recommend it. So lots of talk about the FEGLI Basic. Let's switch to the other options real quickly. Just talk about these. And understand, guys, I haven't even got into general estate planning. And if you came on for that discussion, apologize, you're after going through the benefit side, but this is a federal benefit type of presentation. So I'm talking about those core benefits first because they do affect your estate plan. So FEGLI optional options. Okay, you got A, negligible amount of coverage, 10,000 bucks. It was the first extra option back in the day when $10,000 was a decent amount of money. Okay, now it's essentially not. Age is a factor of cost, but because it covers so little, age being a factor of cost really doesn't matter. Okay, what I do like about option A is you can parlay that to a free policy. There is the 75% reduction option on option A and option A only. Okay, outside of basic. Option B. Option B is like the most popularly used one. And we see some mistakes happening with option B. So that's why we wanted to throw this on here, spend a couple minutes on this slide because we see some mistakes with federal employees on option B. Option B allows you to insure up to 5 multiples of your salary over on top of that basic coverage. right? So for that reason, you can really put a lot of life insurance on yourself through option B very inexpensively earlier on in your career. But because option B prices up by 70% um, every 5 years, it becomes a very expensive benefit to be hanging around through really those late 50s and 60s. You could see someone that's 50 through 54 is paying about 21 cents and change for every $1,000 of insurance coverage through option B. Someone that's 70 through 74 is paying $1.86. Okay. That's that doubling effect of that price increase by every every 5 years. So for that reason, option B is pretty much impossible to take into retirement. And that might become of a shock to some people. They might have been using option B simply because it was inexpensive. They didn't know about the price increases, and they're like, hey, that might just be something I carry for my kids in retirement. Nope. That's more of a temporary life insurance coverage, to be honest. And what we would recommend is if you've got, you know, you foresee a big mortgage, that you're carrying into your 60s, maybe you have some younger children that are still in college, and you really have a need for larger amounts of life insurance during that age frame. By 50 years old, you should really start making a decision on taking your coverage to an outside carrier that's going to lock in that pricing for you for a set amount of time. So that's where you can look at different types of life insurance policies that will lock in pricing as opposed to that reset every fifth birthday. Option C, right? That's family insurance. I'm not going to spend a lot of time on that just because I feel like I spent a ton of time on FEGLI already. But most people know what option C is. It's got small multiples that cover the family, and that's not really eligible to be taken into retirement either. So there you have it, right? It's basic and option A that you can take to retirement. If that changes how you're using these, it's good to know now, just because we see a lot of people that kind of are misled or just misunderstanding of the FEGLI life insurance. I had a question. Does option B go up every 5 years regardless of age, or does the price increase start at a specific age? Great question. It's every fifth birthday. So it's 50, 55, 25, 30, 35, 40, 45, 50, every fifth birthday. So you're not going to notice really a big difference earlier in your career because it's really cheap then, but it'll start to really build on itself towards that end of career when you start to receive that higher insurance cost. So I believe our next slide just talks about those outside insurance options. So you got whole life, universal life, variable life. These three are pretty much permanent life insurance coverages. Variable life uses an investment chassis. Whole life does not. Universal life is a mix between whole life and variable. So there is an investment chassis, but there's also a guarantee that if you pay a minimum payment, your insurance won't lapse. So universal is a pretty popular option because it gives you kind of that ability to have an investment chassis of mutual funds for your cash policy and gives you that protection against lapse. I'd say that's kind of probably these days the number one used policy when it comes to the permanent types, right? But term life, I would say, is probably the most popular option because that is the lowest cost. Term life allows you to buy some insurance for 15, 20, 25, 30 years, let's call it, and fix that pricing in, right? Lock it in. It's not going to have every 5 year increase. So that's a little different than your FEGLI option B. You may price that out in your 30s and say, well, option B is cheaper, so why would I go with term? It's because term's going to lock it in, and you'll notice down the road it will save you some money by locking that price in. If you get term, let's say before you get into really that meat of your 50s, okay? I say if you lock in a term policy by 50 or earlier, you're going to get some pretty good pricing on term. It's really inexpensive and it'll lock in that pricing, no surprises down the road. Especially if you've got a reason for only needing temporary coverage. That's a good one. All right. So guys, I'm wrapping up the federal benefit side. If that's not what you tuned in for. I apologize, but I do think it's really important to get an understanding of the federal benefits that affect estate planning. Here's popular forms that your beneficiaries should know about, whether it's TSP beneficiaries, whether it's FEGLI beneficiaries, that lump sum benefit, or the survivor. Those are all forms that can be accessed here. And it's important for your your beneficiaries, your spouses, to know what benefits you have. I mean, think about this. If you don't know what your benefits are, if let's say you didn't actually know about that surviving spouse benefit that's outside of FEGLI and that's outside of the the lump sum one I talked about, how in the heck is your surviving spouse or partner going to know about it, right? So you'll be surprised how little folks educate their family on what they have. And when death comes, right, people are just thrown in a situation where they're just trying to figure out what that person had, where it was, how they access it. So it's really helpful to have that laid out where the forms are used, and that will give that person a head start on your estate plan, figuring out what's what. All right, healthcare documents. So now we're going to get into the general estate planning portion. We're going to talk about what everyone should at least have at the bare minimum. We're going to talk about some power of attorneys right here. So first is a power of attorney for health. Everyone should have one. This usually comes with the general estate plan. If you're getting a will done by an estate planner, you're going to get a health power of attorney. That document allows someone else to make decisions on your behalf when it's regards to health, and you can't do that for yourself. Very key piece of document there, comes into play a lot if someone has to go under, and let's say they have no ability to make that decision. Let's say they found something else wrong with them while they're having that surgery. That power of attorney for health can make that decision. It happened in the case of my family, my grandfather and his sister. My sister went under the knife. They found like an intestinal blockage while she was being operated on. They basically told my grandfather, "Look, we got to fix this too." He was able to do that as her power of attorney for health without her having to go through two separate surgeries. So I've seen it just come in handy with my own family. Now, that is different than a living will. So a living will is a medical health directive. That is solely about life sustainment options. You're incapacitated, don't have the ability to care for yourself. How long are you on life support? What do you want your family to do? What's your instructions? That's that medical health directive, also known as a living will, which kind of throws it off a little bit. Living will, you wouldn't think is a medical health directive, but it is. So when you get those documents, generally a will is going to precede them, right? So a will is the most popular used estate planning document that there is. But one thing that a will is subject to is probate. And probate has its disadvantages because it allows an estate to be tied up in limbo if there is a fight over the estate. And by fight over the estate, that could come from the family, family members that were left out. That could come from debt collectors that have a claim on your estate. So all those things can tie up an estate in probate court. And if that happens, a judge would have to overrule on this and decide if is this will valid, or should this judge make a decision on their own accord to include some of the beneficiaries that were part of that claim that were excluded from that will. Now, if your family scenario is very simple and you do not foresee those types of things happening, you don't have, any real debts besides your mortgage and things like that, a will is generally going to be good enough here, right? But for trickier estates, you can avoid probate with the 5 different options below, and that last 5th option is a trust. That's why people get trusts instead of wills, or get trusts in addition to wills. But some other types of options that do not go through the probate process are transfer on death or payable on death accounts. So what does that mean? That means you open up an account through a bank. you open up an account through a brokerage firm, financial firm that's non-retirement. These accounts generally don't come with beneficiaries, but you say to the bank, I want to put a beneficiary on my accounts, regardless if they're retirement or not. That's called transfer on death, payable on death instructions on that account. And what that's going to do is it's going to bypass any will that you have and go directly as that document states to the beneficiaries that you're putting on that specific account, and therefore no probate. So your will could say, I want all my assets to go to my son, but you have a transfer on death instruction that all your assets go to your daughter. Okay. That's what is going to be used, and probate won't be able to save that process if your will said something else. So that could be a good or bad thing, and you would want to make sure your beneficiary is up to date on in that case. Same with your retirement plans, right? So the TSP, right? IRAs, those accounts. If you have your beneficiaries on those accounts, and you should, your will does not have any say on where those assets go. It's those beneficiaries, right? And for that reason, avoids probate. Same with life insurance, your FEGLI. Same with joint accounts, right? That goes directly to the other person on that joint account. So trusts are the same. Trusts don't go through probate. So there is no process of a judge ruling or any sort of debt, final debt type of collection at the end. Trusts really kind of protect from those scenarios, and those and that estate just kind of moves forward as opposed to having any sort of middle ground, if that makes sense. Um, so let's talk a little bit about trusts, but I did get a question come in. What is probate? So I don't know if I was clear. So probate, again, is that middle ground, is that area where someone dies, you're going to file an estate in court, and that's going to be probate court. You're going to be sending in the will, the letters of testamentary, those types of things to the estate court, probate court. And that's where the judge will rule if there's any sort of delay that needs to happen with this estate based on the will, those types of things. So that's probate, right? And that's why probate can be held up. If it's held up, fees get associated with it, right? Because there's legal fees. There's fees for the court. There's fees for any attorneys involved. That's why trusts are popular, because they avoid that process. They skip kind of that middle part. So the reasons to use a trust: number one, avoid probate, right? Protect assets from creditors. Creditors generally cannot pierce a trust. The management of assets, if that's going to be assigned to someone else other than beneficiaries, let's say someone that's more responsible, right? Split interest in a property, we don't see that a lot. Minimizing taxes. So minimizing taxes. How do trusts minimize taxes? Well, if you have a trust, you can save taxes on a trust, generally speaking, for your beneficiaries, if that trust is irrevocable. Okay. Right. Now, there are some benefits to trust outside of that, like transfer of future appreciation to heirs, which gets that. If you're having a trust that you create for those heirs, you can get that essentially out of your own taxation, right? So let's say you're paying capital gains and income taxes on that. You want to put that in a trust right now for those beneficiaries. That will remove that out of your own personal income tax situation if you have a pretty high income tax situation. We don't see that a lot for the general person, right? So this is more so for someone that's called higher net worth. And then we also have the generation, minimizing generation taxes also. But irrevocable trusts receive further tax benefits. This is where we're going to see people potentially utilize this for just a general person here. So if you set up an irrevocable trust, so what's an irrevocable trust? That means you cannot make a change to that trust document. It's set, it's locked in. Okay, whoever you picked as your beneficiary, can't change it, right? The income is taxed to beneficiaries if it's distributed to someone outside of yourself. You are the grantor usually to a trust. You grant property, whether it's stocks, real estate, whatever it is, that income that gets generated in that trust, if it gets sent out to someone else that's not you, right, then that income tax is taxed to those beneficiaries. So again, let's say if you're in a higher tax bracket, your kids are not, you want your kids to receive some money. You put that money in a trust, make it irrevocable. That income that's generated off that trust is no longer now going to be taxed to you. Okay. A second benefit of that is going to be the reduction of one's estate. Okay. So let's say you're in jeopardy of having too large of an estate where there's going to be estate taxes applied. I'll talk about the what we consider large or not here in a second and where estate taxes apply. But if you wanted to reduce your estate, you could transfer this property to an irrevocable trust, and now that will now be excluded for estate tax purposes. Okay. So look at this exclusion really quickly, and I just got a question. Is it better to just add your children to the deed of a house than having the will instructing the house to go to the kids, or is a trust better? Which option is ideal in terms of tax advantages, less administration burden? Great question. We never recommend adding your kids to the title of your house. The reason for that is they are going to lose one of the best tax benefits, which is called a step up in basis, which I'm about to explain here in a couple slides, if you do that. Okay. We always prefer that kids inherit your real estate assets when they pass away, if possible. Okay. Um, and that goes for assets like real estate or appreciated stock that don't exist in a retirement plan. It's called the step up a basis rule, and it only occurs at death. Okay. Let me finish off a point here. We'll get to that particular question here in a second. So here's the estate tax exemption. So that last bullet point on the previous slide, which is you can exclude assets from your gross estate if it's over the exemption. These are the exemptions. So I ask most people, right? Are you going to find yourself over the current exemption? The answer is probably no. Now, keep in mind that these current exemptions were set forth in 2018. Thus, in 2026, they're set to expire and revert back to the old exemptions, okay, which you see right there in 2017. Now, they'll be adjusted a little bit for inflation, right? But those levels might be more, what's the word I'm looking for? Uh, Likely that your estate may cross over, but certainly not the ones in red, right? For the average person, right? Including myself. So we may see those taxes, those exemptions revert down. We think that eventually they will and revert down to those ones in 17. Keep in mind, right? Previous administrations had lower exemptions that we've had in the past. Back in the 90s, it was a $1 million exemption for single and 2 million for joint. So that is where a trust, an irrevocable trust, would come in hugely, simply because a lot of people would be over that exemption. So we don't know what these exemptions will do in the future. We know that the current ones are set to drop off, revert back to those old ones. So as of right now, we don't see a lot of people using an irrevocable trust to lower their estate tax by transferring assets outside of their estate to that of a irrevocable trust to save on these taxes, because most people are under this exemption. Okay. But let's say you were over the exemption. Your state came in at over the exemption. Let's use the blue ones. Let's say you were single, you had over $5.6 million in assets. Let's say you had $6 million in assets, right? Well, that means your estate is going to be taxed at anything over that exemption of 5.6. So that would be the 400K in this example I'm giving you, right? 6 million is your estate. 5.6 is the exemption. So that gives us $400,000 of overage. So the $400,000 of overage is going to grab the tax rate, and let's just, for simplicity, point it to where that's going to be, which is right here. Between the 250 and the 500 mark is about a 34% estate tax, only on the overage, not the 5.6 million. That's free. Okay. So that's how estate taxes work. So generally speaking, families don't pay estate taxes. I get that question so many times. Oh, is my beneficiaries going to pay estate taxes? I'm like, are you leaving over, 5.6 million or now right now 11 million? Likely not, right? So no. I can say no like 99.9% of the time. Now, states also have what's called inheritance tax. There's like 17 or so states. You need to double check that for your state. Those limits can be a little bit less, right? Inheritance tax is different than estate tax. Estate tax is federal, inheritance tax is by the state. So a trust can help out that scenario for inheritance tax from the state. But a lot of these states are higher amounts as well. Okay. Um, I, I haven't looked at the ones in the DC area. I'm assuming most people are tuning in from the DC area, but there are inheritance taxes on the states in the DC area. Double check those. You can just type in inheritance tax by state and on Google, and those will come up. All right. Do you have information on special needs trusts? Great question. So a special needs trust is a whole type of different trust for someone that's disabled. It sets forth covenants on how that estate can be used, how that trust can be used specifically, or that estate be used for that trust. I don't have any specific slides on that, Angela. Do you know what? You bring up a great point here, and I think it's something that should be included. I'm gonna put a little bit more time and effort into that slide, and maybe in the future add that as something in here, because you're not the first person to ask about it. But it's very similar to what this. So here's some different types of trust. Okay, so this is where we were going to kind of talk about special needs trust. It's a living trust. It continues to live while, let's say, the person that's put money in it is alive. Testamentary trusts are usually set up when someone passes away. So they'll have a will that goes into a testamentary trust for specific situations, usually going to be marital and family situations. Living trusts are trusts that get funded right now during your lifetime, like a grantor, charitable, or that special needs. I don't have any color around special needs beyond this, and I know I should, but the special needs trust really is for that disabled person, the use of assets for that disabled person. And the way that a special needs trust is going to work, Angela, just to kind of address your question here, is it's going to work similar to what you see here on this graph. Okay. So imagine if this was a special needs trust. You, the grantor, are transferring in assets to that trust. You're going to appoint a trustee. A lot of times that's going to be yourself, right? You are the trustee. You essentially now manage the trust. What does that mean? That generally means you're managing the assets. So in a trust, a special needs trust specifically, you're transferring assets to a trust, right? You're going to be setting up most likely a investment account with a firm. You're going to be buying typically, mutual funds or whatever it is that you buy in that financial account. And what is going to happen is that is going to be for the benefit of someone else. So in that situation, that income that is being used for that other person is going to be taken out of your personal income tax situation. That's what a special needs trust does in terms of benefits for you. You're not using it for yourself, right? You're using it for someone else. Now, in that case, that would have to be set up as an irrevocable trust for that type of taxation benefit to happen, right? But if it's irrevocable special needs trust and that income is being used for someone outside of yourself, you've now transferred that tax liability to that other person, and that person that has no income, that's going to be almost next to nothing in taxes. Now, the remaining beneficiary in a special needs trust is likely going to be the person that has special needs as well. So that is going to be who receives that trust, or it's going to live on beyond your death. Someone else, a secondary trustee, is going to come in to manage that for the income of that special needs person. And that remainder beneficiary will, in that case, be, let's just call it the special needs person's children. I'll give you an example. My mom's special needs. She's got a special needs trust. Okay. In this scenario, the income is used for her, right? My grandfather is the primary trustee. I'm the secondary trustee. When my grandfather passes, it's my responsibility to manage what's in that account for my mom. Then once my mom passes, right, the remainder beneficiaries are me and my brother. That's how it works, right? So I hope that addressed your questions. I think I at least was able to pull that off, even though I didn't have specific stuff around the special needs. But this diagram hopefully helps. Next question, is there a transfer on death instruction for a house? Is a house always subject to probate if it's not in trust? Man, you guys have really pointed questions that are right on time. Okay, because that's the next slide. I'm going to address that question about a house right next. Next question. Thanks, Angela. Appreciate the feedback. Is the exemption calculated based on all assets? That estate tax exemption? Yes, all assets, retirement accounts, houses, assets, cash, even non financial items like tangible items are also included in that estate calculation. So that'd be jewelry. Question, my spouse and I have wills that include a trust for minor children. Does the trust get set up by our attorney if we pass away, or is there something that we need to do now? Generally speaking, that will fund those trusts in that case, and that will be set up by your attorney, and it will be executed by your executor that you named in your will. Yep, at the time of death. So that's a testamentary trust, typically for a minor that gets funded after you pass. All right, so that clears down the questions. Let's move and address the first question that came in. Oh, I forgot. There's one other slide before the house slide. Donor advised fund. What we throw this in here, it's just a quick thing for people to know that, like, if you don't want to set up a charitable trust, which takes some money to set up, you can get some of the same benefits by donating to charity by using a donor advised fund. Donor advised funds are set up with financial institutions. They allow you to make lump sum contributions or annual contributions into an account, throw it tax free, and then decide which charities receive that at a later date. But you get that tax deduction up front when you contribute to that account. So it's kind of similar to a charitable trust. When you contribute to a charitable trust, you get a tax deduction. That's why people do it. Then it's for the benefit of charities that are in that trust. But donor advised fund kind of accomplishes those same things without you having to create a trust. All right, jumping ahead. I'm going to be running out of time, so I'm going to save the rest of the questions to the end. I generally do that anyway, but this was a smaller group, so I took questions while we were going. All right, transferring the house. All right, so transferring a home outside of probate. So homes don't skip probate. They go through probate. Any asset that doesn't have a beneficiary is a probatable asset. Think about it. If you don't have a beneficiary on whatever, it's going through probate unless it's in a trust. Getting a house into a trust can be kind of a pain because you have to redeed that house to a trust. So what are your other options? You can do these two options, a TOD deed or a life estate deed. Now, keep in mind the TOD deed um, is not available in all states. So Maryland is not one of those states that have the TOD deed, but it does have the life estate deed. So what do these two things do? If they're attached to your home, and they can be set up generally through an attorney, and they're relatively inexpensive, and they get recorded with the county, you essentially have now set up a beneficiary to your home. And when you got a beneficiary on an asset, what happens? It avoids probate. So the difference between these two is simply that the life estate deed cannot be changed unless it comes with beneficiary approval, where the TOD deed can be changed. That's what makes that a nicer option. But again, not all states have that. But this is a way to essentially add that beneficiary to your home without creating the trust. And another personal situation where a family member of mine passed away. They had that, they made it super simple, and then transfer that asset into the next person's name. How? Death certificate. No will was needed, nothing was needed. I simply took a death certificate, send it to the county, said that person passed away. They had a life estate deed on that property. The county then changed the name to the beneficiary. That was it. Done. I didn't have to go through an attorney. I didn't have to do any of that stuff. So that's what doing this does in terms of making that simplicity and easy for your surviving children or whatever it is you're leaving your real estate to. All right. This now addresses a question that came up about 15 minutes ago. Step up in basis. Why would I not title a real estate property to my children right now? Because they wouldn't receive a step up in basis. What is a step up in basis? Well, it is when, let's talk about what is not a step up in basis real quick. Let's say I bought a home for 200K 20 years ago. Let's say that property is now 500K. Let's also give you a quick little joke. Let's say I didn't buy that property for 200K 20 years ago. Let's say I bought it 5 years ago, because that's kind of what happened in real estate. Oh my Lord. Anyway, 200K went to 500K after COVID, right? Okay. Well, I now have a basis of 300K. That means if I sell this property now, I'm going to owe taxes on what's called the capital gain. And a capital gain is a difference between what you bought the property for versus what you sell it for, right? Of $300,000. Now, capital gains are either going to be long-term or short-term. When they're long-term, they typically get taxed at a 15% tax rate, right? So in this scenario, I'm going to owe taxes on the difference, 15% on that 300K. And so would my beneficiary if I made them a joint owner while I was living. So let's say, my son, I put on the deed of this property when I'm alive. They now are responsible for the taxes from when that was originally purchased when they go to sell it, because they own that property before I died, right? Which means they inherit the original basis. Now, what happens after death is this rule called a step up in basis, and it allows the basis to now be lifted to the date of death as opposed to the original amount. So now I've inherited this property, let's say through my family member, at 500K, because that's what it's worth now. I go to sell that property for 500K. I owe no tax. I owe no tax. Okay. So that is a much better method. And that is what that Ladybird deed or that TOD deed do. They allow you to still essentially set up that person to getting this property, right? Real easy with the death certificate when they pass away. They're not recorded as owners just yet, but they're pretty much lined up as the next owner. Real simple process for them to shift ownership over to themselves and get that same tax advantage with the step up in basis. Okay. That's why we would much rather use those two examples shown in the past slide versus outright changing the name of a beneficiary to that person owning it right now. All right, so I'm running out of time, but I wanted to talk a little bit about the responsibility of an executor real quick. A lot of times you're going to be on the receiving end of an estate as opposed to the latter. You're only going to die once, right? And your beneficiary is going to take care of your estate, but you're going to see family members pass away way more than the latter. And you're potentially going to be in the hot seat as an executor, or at least helping someone that is an executor. This is a checklist of essentially a timeline of what you need to do if you're an executor, right? You need to obtain death certificates because there's some firms that are going to want original death certificates. They were not going to want copies. So the copies need to come directly from the court there. Yes, you can make copies of the original, but you'll find that one bank that says, no, I want the original. Okay. There's a certain seal, raised seal of a notary on those. You're going to file the will in probate court and obtain a letter of testamentary saying, hey, I am the executor. From then, you're going to file a tax ID. A tax ID is a social security number for an estate. So understand this. Let's say you're the sole beneficiary of an estate, right? And things go through probate. All assets must be payable to the estate first before you can transfer that to a beneficiary. So that's another step, right? If you were the beneficiary of something, like let's say your TSP or a TOD account or a Ladybird deed, all you would need is a death certificate. That asset goes in your name as the beneficiary pretty much immediately. But if it goes by the will and it goes through probate, the assets need to be payable to the estate first. And it's an account that actually gets set up as an estate account. And there's taxes that are associated with that. Okay. So that's where you're going to set up that estate account. You can't do it without the tax ID. That's kind of annoying. Okay. So again, that's where trusts don't have that. Locate assets, right? You're going to pay those out to the estate account, pay ongoing expenses and debts, and you're going to file a final income tax return essentially for the estate. Any income that account earned while it was, collecting assets and then paying out to those beneficiaries, that's where you're going to file that final income tax return. All right, I'm rushing and I know that I need to get you guys out within the hour. I just wanted to talk real quick about the Secure Act 2.0. I think I made a mistake by doing your questions kind of in the middle. I honestly should have stuck to the end, but there was only 34 people on this one, so I figured I could. But there's just too much to cover. Secure Act 2.0, though, some big changes. It increased the required minimum age on your thrift savings plan to 73. It removed the requirement of withdrawals from the TSP. It allowed a penalty-free rollover from 529s to Roth IRAs up to 35,000. And it requires non-spouse beneficiaries to withdraw all assets from an inherited retirement account within 10 years. I'll show you a quick example of that. Let's say you have a TSP traditional. Your non-spouse inherits your TSP traditional. That's all taxable if they withdraw it in one lump sum. That would be a big mistake. So what are they going to do? They're going to extend that over the 10-year rule. They're going to try to keep themselves within the same tax bracket. In this example, we're using 24%. And by that 10th year, they got to make that final withdrawal. So in this example, they're probably collecting somewhere around 460 in after-tax money from inheriting your traditional plan. Taking out 500K would be an absolute, again, mistake all at once because you'd be sent to the highest tax bracket as a beneficiary. Check out a Roth, though. A Roth, 500K, it's tax-free. I could take that out right away as a beneficiary and not get taxed. But if I'm a smart beneficiary, I'm going to keep that within the covenants of an inherited Roth plan and continue to extend the tax-free growth that happens over that 10 years. Whereas if I took that out and invested it, I would have to pay taxes on any capital gains or earnings by the year, right? So if you invest outside of a retirement plan, you have to pay taxes every single year on income, capital gains that are short-term, and if long-term capital gains when you sell assets. But there's taxes associated with growth there. Roths do not have that. So I would keep that money there. And by that 10th year, I would make that final withdrawal because I have to. And essentially that's when I would collect all that money from that Roth plan. In this case, right, you have $815,000. Big difference between inheriting a traditional or a Roth, right? Should I make a trust a beneficiary? Generally not. Trust income that is not paid out to the beneficiaries is taxed at a higher taxation than personal income taxes. So generally speaking, we're not going to recommend a trust as a beneficiary unless it's special needs or something like that. We like physical people to be beneficiaries of people's retirement accounts just because it has less complexity around that. Check out the tax brackets. Tax brackets, we are expecting those to increase. Look at last year's versus the ones in 2018. Just notice the differences in these tax rates, right? 24% versus 28, and the ranges of income that these covered. So again, if you're leaving money as traditional to beneficiaries, you're likely going to put them in a higher tax bracket when they're receiving that money. And for yourself, watch out because at 73, that's generally when your RMD from your traditional plans is going to begin. And if that spikes your income then because you're on pension and Social Security by then, this may increase your tax bracket for yourself, right? That RMD in a lot of cases for federal employees, let's say you got 22, 24%, and then all of a sudden at 73, you're seeing yourself in 28%. That's something that you need to look at and start to think about that Roth option just for yourself, not just your beneficiary. So again, sorry for going over here. Miscalculated a little bit of the time, but here's that kind of one-on-one invitation. If you're interested in getting more of a consultative process around some of the issues that are up on this slide, whether it's should you be using more Roth TSP, whether for yourself or your family, TSP allocations, when you should retire versus when you can, or just questions about Medicare and how that relates to FHB. We have different sessions on that, but these are the invitations. I will say this: schedules are very packed for these consultations. We make a window open in the next month for you guys to get in. Other than that, there's about a 3 to 4 month wait to do a one-on-one consultation right now. All right, just because clients get precedence, and then new folks coming in off presentations, but just people just signing up kind of off of any sort of other methods, there's a wait time for that. So be sure if you're wanting to do this soon to schedule that as soon as possible. You got the QR code and you've also got the website there. I'll skip this, but looking for a financial advisor, I would check these 3 things. Having someone with a federal background, I think is always going to be beneficial. Having a CFP, checking the background on BrokerCheck, I think is very helpful. If you want a fiduciary financial advisor that's giving you investment advice, make sure they're an RIA. Otherwise, they're going to be a commission-based advisor on transactions. They're going to be looking to sell you insurance policies. They're going to be looking to sell you annuity policies, things that generate commissions through transactions as opposed to investment portfolios with a flat cost. So really try to stay away from an advisor that is not an RIA that's giving you investment advice, in my opinion, if you want a fiduciary exchange with that advisor. Alrighty, that's that registration slide one more time. I'll do some questions if there's still some there. We have a survey. Feel free to take that out, to take the survey. We can share that with your administrator. Someone asked about the PowerPoint and recording. Yes, that'll be sent out to you. And thank you so much for your feedback. I honestly didn't think I did an excellent job at the beginning because I kind of was a little slow. I also had a really rough night last night. I got a stomach bug and slept maybe only 4 hours. So I honestly was wondering at 5 a.m. when I had nothing slept yet if I was going to cancel this. But it's kind of crazy what coffee will do for you, right? I'm pulling through at the moment. So thank you guys so much for the feedback. I feel like at least I did good enough to get you everything you needed to know. I used this barcode from the previous webinar and I never got a response for a checkup. Really? You You should have got an email response that gave you the instructions to set up your meeting. Now, yes, our office may not have followed up after the case if there were some things that you needed to do first, because we do leave that up to you, if there's further information required, but that shouldn't have happened. So if that's the case, I would re-sign up and see if that changes things. All right. Thank you again for your feedback. Thank you. Yeah, I'm gonna get some rest. I'm one of those people, I can't sleep during the day, even though I desperately want to. So I'll just pull through until maybe 9 p.m. and crash early. Um, Marcy, thanks. Okay, thank you so much. So yeah, at this point, it's more so wishing me better. So thank you guys. I appreciate that. I wasn't even gonna mention it, but figured I would. All right, you guys take care of yourselves and please, 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 if you got any follow-up questions, let us know. We're here to help. And it was great to spend some time with you all today. Take care until next time. Spread the word to your colleagues, send the recordings, send the sessions. You can always share our information with colleagues if they need some information or a one-on-one meeting too. All right, you guys have a great rest of your day, and we'll be seeing you guys up in a hopefully new session here.